Hello everyone, my name is Skye and I'm a portfolio manager at Johnson Investment Counsel, and this is the JIC Research Edge. I'm joined today by Brandon Zureick, who is the firm's economic strategist as well as a fixed income portfolio manager. Brandon is here to provide an update on the economy. So, jumping right in, Brandon, 2019 was a really eventful year for the global economy. Would you mind giving us a recap of the highlights?
Sure, 2019 really was dominated by policy. On one hand, the president's tough stance on trade with China undoubtedly contributed to a slowdown in global economic activity. Domestically, the manufacturing sector was hit the hardest, and despite pretty solid consumer spending throughout the year, really investors had renewed fear that perhaps the longest economic recovery on record was in jeopardy. On the other hand, in response to this global economic growth slowdown, the Federal Reserve cut rates 3 times. And so this easing of monetary policy helped to stabilize economic growth and perhaps contributed to stock markets achieving new all-time highs. So really 2019 was a tug of war between the headwinds of tighter trade policy and the tailwinds of easier monetary policy.
Right. You alluded to investors' recession fears. It seems as though fears of an economic recession have subsided for now. What key indicators are you watching to make sure that the economic recovery is not in jeopardy?
Yeah, today's environment does share a couple of key similarities with other pre-recessionary periods. For instance, the unemployment rate is just 3.5%, essentially an indication that labor markets are very tight. Also, the yield curve has temporarily inverted, meaning short-term rates are higher than long-term rates, perhaps a sign that the Federal Reserve tightened policy too much in 2018. In contrast to other recessionary periods where these preconditions are oftentimes followed by a sharp contraction in broad economic activity, we simply haven't seen that today. So a lot of the key variables that we're keeping an eye on, for instance, the pace of hiring and jobless claims, simply have not deteriorated to a level that would be consistent with a near-term economic recession. So we're keeping a very close eye on the labor market data, and any further deterioration could perhaps warrant a more cautious stance as we head into 2020 and beyond.
Thanks, Brandon. Recent news suggests that the US and China have agreed on a Phase 1 deal on trade. How does this agreement shape your outlook for the year to come?
So we believe that the economy is at an important crossroads today. And one key to understanding which direction the economy heads is more clarity on trade. So a material reduction in the amount of tariffs could possibly boost the pace of economic growth next year, while any breakdown in negotiations and a ratcheting higher on tariffs may jeopardize the current economic recovery. So while it's a good sign that the two sides have been able to come to the Phase 1 agreement, what was actually agreed upon was not necessarily significant enough to alter our view one way or the other. So our attention is instead turning to Phase 2 and negotiations beyond for signs that we're heading in one direction or another.
Thanks for your time, Brandon, and thanks to all of you at home for watching. If you have any questions, please reach out to your portfolio manager.